Have you ever wondered why long-term investing sounds simple, but feels incredibly difficult in real life? Everyone talks about buying and holding, yet when markets drop or headlines turn negative, sticking to the plan suddenly becomes much harder. In this video, I'm going to break down the real reason long-term investing is so hard, what actually causes investors to give up too early, and how understanding this challenge can help you stay on track. Once you see what's really going on, investing becomes far more manageable. Before we jump in, if you want clear, realistic investing insights that help you think long-term, hit the like button, subscribe, and turn on the bell so you don't miss future videos. Your brain wasn't built for this. Our brains evolved to survive danger, not to invest wisely. In the wild, reacting fast kept our ancestors alive. Today, when markets drop, our brain treats it like a real threat. Heart racing, panic setting in, urging us to act. That's not weakness, it's evolution. But what helped us survive back then hurts us in investing. The market rewards patience, while our brains are wired for quick reactions. Panic selling isn't fighting the market, it's fighting millions of years of evolution. The pain of loss hits harder than the joy of gain. Losses hurt about twice as much as gains feel good. This is called loss aversion. A 10% gain feels nice, but a 10% drop feels painful and overwhelming. You obsess over it, lose sleep, and think about selling. One bad month can erase the confidence built over years. Market crashes hurt so much not just because of money, but because our brains are wired to fear losses more than value gains, even if quitting hurts us in the long run. Everyone around you is freaking out. Investing doesn't happen in a vacuum. When the market crashes, you're not just dealing with your own fear. You're dealing with your coworker who just sold everything. Your brother-in-law who's convinced this is the big one. The news anchors using words like bloodbath and catastrophe. Social media exploding with panic and doom. Humans are social creatures. We look to others to understand how we should feel and what we should do. When everyone around you is running for the exits, staying calm and holding your investments feels less like discipline and more like denial. You start to wonder if you're the crazy one. What if they know something you don't? What if you're being stubborn instead of smart? This social pressure is invisible but incredibly powerful. It's easy to be a long-term investor when markets are calm and everyone's making money. You can't see the future, and that terrifies you. Long-term investing requires you to make a bet on something you can't possibly know for certain. Will the market recover? Will your stocks go back up? What if this time really is different? The uncertainty is torture. Our brains hate not knowing. We'd rather have a clear bad outcome than sit in ambiguity. This is why people often sell at the bottom. Not because they think the market will never recover, but because they can't handle not knowing when or if it will. Selling feels like taking control. It transforms an uncertain loss into a certain one, and paradoxically, that can feel better. At least you know where you stand. The market is going to keep doing what it does, dropping and rising in ways that no one can predict with certainty. Long-term investing means accepting that you won't know what tomorrow brings. You won't know if you're down 3% or up 3% next month. That lack of control, that sitting with uncertainty year after year, is psychologically exhausting. Short-term noise drowns out long-term signal. Open any financial news site, and you'll be bombarded with information. Market up today, market down today. This stock is hot. That sector is crashing. Analyst upgrades, analyst downgrades. Breaking news every single hour. The problem is none of this daily noise matters for long-term investing. But our brains don't know that. Every headline feels important. Every notification feels urgent. When you're constantly exposed to short-term information, it's almost impossible to maintain a long-term perspective. You start to think in days and weeks instead of years and decades. Each daily fluctuation feels meaningful. Each piece of news feels like something you need to act on. This is exactly what long-term investing requires you not to do. You need to ignore the noise. But ignoring the noise when it's everywhere, when it's designed to grab your attention and trigger your emotions, is incredibly difficult. The media isn't trying to make you a better investor. It's trying to keep you watching, clicking, and reading. And the best way to do that is to make everything feel urgent and important, even when it isn't. The boring middle kills your motivation. Here's something nobody talks about. Long-term investing isn't just hard when markets crash. It's also hard when nothing is happening. You put money in, years pass. Maybe you're up a little. Maybe you're down a little. There's no excitement, no big wins, no dramatic comebacks. Just boring, slow, unremarkable progress. And boredom is dangerous. When investing is boring, you start looking for something more exciting. Maybe you hear about someone who made a fortune on crypto, or your friend who's day trading and posts screenshots of his wins. Suddenly, your boring index fund that's up 7% this year feels like a waste of time. You're not losing money, but you're losing interest. And loss of interest leads to abandoning the strategy. The most successful investors aren't the ones who make the smartest trades. They're the ones who can tolerate being bored for decades. They can watch their accounts grow slowly without needing the dopamine hit of a big win. Most people can't do that. We want action. We want results. We want something to happen. Long-term investing offers none of that, and that's precisely why it works. But it's also precisely why so few people can actually stick with it. You don't have a real plan for the bad times. Almost everyone starts investing with good intentions. They read the books. They understand compound interest. They know they should stay the course. But when the crash comes, all that knowledge evaporates because they never actually prepared for what it would feel like. Knowing intellectually that markets go down is completely different from watching your retirement account lose 30% of its value in a month. Most people don't have a real plan for this moment. They don't know in advance what they'll do when fear takes over. So when the crash happens, they're making decisions based purely on emotion, not logic. A real plan isn't just saying you'll hold through downturns. A real plan is writing down exactly what you'll do when your portfolio drops 10%, 20%, 30%. It's deciding in advance whether you'll buy more or just hold. It's accepting emotionally, not just intellectually, that losses are part of the process. Without this preparation, you're setting yourself up to fail. Because when the moment comes, you won't be making a rational decision. You'll be in survival mode, and survival mode wants you to run. When you step back and look at it, long-term investing isn't difficult because of the strategy. It's difficult because of human behavior. The biggest battle isn't with the market, but with your own emotions and expectations. I'd love to know, what makes it hardest for you to stay invested during market ups and downs? Share your thoughts in the comments. You're definitely not alone. If this video helped you understand why long-term investing feels so challenging, don't forget to like, subscribe, and share it with someone trying to build wealth patiently over time. Thanks for watching, and I'll see you in the next one.